March 2020, the world is shutting down. Millions are losing their jobs. And in a single week, American billionaires made $434 billion. Not over months, 1 week. While you were panic buying toilet paper and wondering if you'd still have a job, the wealthiest people on the planet were executing the greatest wealth transfer in modern history. Jeff Bezos added $13 billion to his fortune. Elon Musk gained over $100 billion during the pandemic. Mark Zuckerberg, $42 billion richer. But here's what should terrify you. This wasn't opportunism. This wasn't luck. This was a system operating exactly as designed. Because in our economy, the greatest profits don't come from creating value. They come from engineering chaos and being positioned to exploit it when it hits. Here's what most people miss. We think of economic crises as failures of the system. Market crashes, bank collapses, mass unemployment. We're told these are accidents, unforeseen consequences, black swan events that nobody could predict. That's the lie they need you to believe. Because the truth is far more disturbing. What if I told you that crises aren't system failures at all? What if they're features, not bugs? What if the entire financial architecture of the modern world has been deliberately constructed to concentrate wealth during moments of maximum human suffering? Let me show you exactly how this works. Stage 1, building the machine. To understand the system, we need to go back to 1971. That's when President Nixon took the dollar off the gold standard. For the first time in history, the world's reserve currency was backed by nothing except faith in the US government. This wasn't just a monetary policy change, it was the foundation of everything that came after. Without the constraint of physical gold reserves, governments could create money freely, and create they did. In 1971, the total US money supply was about $600 billion. By 2008, it was $14 trillion. Today, it's over $21 trillion. That's a 35-fold increase in 50 years. But here's the critical part, that new money doesn't enter the economy evenly. It doesn't get distributed to everyone proportionally. It flows through specific channels, and whoever controls those channels captures the value first. This is called the Cantillon Effect, named after an 18th century economist who recognized that the people closest to the money printer benefit most. Who's closest? Banks, financial institutions, large corporations, the connected elite. By the time that money reaches workers through wages, prices have already adjusted upward. You're getting diluted currency while others already captured the real purchasing power. Stage 2, the leverage explosion. Now, having control of money creation is powerful, but the real genius was what came next, derivatives. Let me explain this in plain terms because it's crucial you understand what derivatives actually are. A derivative is a financial contract whose value depends on something else. It's a bet. You're not buying an actual thing. You're betting on whether that thing will go up or down. Imagine you don't buy a house, but you bet $1 million on whether housing prices will rise or fall. That's a derivative. Here's where it gets insane. By 2008, the total value of all derivatives worldwide was estimated at $600 trillion. The entire global GDP, everything humans produced that year, was $60 trillion. Think about that ratio. 10 times all the real economic activity on Earth existed as paper bets in the financial system. It was a tower of leverage speculation built on a foundation of actual productivity, barely a tenth its size. And who held these derivatives? The major banks, Goldman Sachs, JP Morgan Chase, Citigroup, Bank of America. They weren't just taking deposits and making loans anymore. They'd become hedge funds, trading houses, and casinos all rolled into one. Stage 3, engineering the crisis. Now we get to 2008, and this is where the pattern becomes unmistakable. Between 2000 and 2007, American banks issued millions of subprime mortgages to people who obviously couldn't afford them. We're talking about loans given to unemployed individuals, immigrants without documentation, people with credit scores below 500. Why would banks do something so reckless? Because they weren't keeping the risk. They were packaging these garbage loans into securities called mortgage-backed bonds, stamping them with fraudulent AA ratings through corrupt ratings agencies, and selling them to pension funds and foreign investors. The bank made its fee and passed the risk to someone else. But it gets worse. While they were selling these toxic products to clients, firms like Goldman Sachs were simultaneously betting against them. They were creating these investments, telling clients they were safe, and then taking out massive insurance policies, betting they would fail. Internal Goldman emails from this period are damning. One executive wrote, "Boy, that deal is shitty." Another bragged about how much money they were making shorting the products they'd created. When the crash came in 2008, it wasn't a surprise to insiders. It was the payday they'd engineered. The housing market collapsed. Lehman Brothers fell. Bear Stearns evaporated. 9 million Americans lost their jobs. 6 million families lost their homes. Total household wealth in America declined by $19 trillion. Stage 4, the bailout harvest. And then came the real crime, The banks that caused this disaster didn't fail. They got rescued. $700 billion in direct bailouts from Congress through TARPA. But that was just what the public saw. The Federal Reserve secretly loaned $16 trillion to financial institutions. $16 trillion, more than the entire U.S. economy at the time. These weren't loans to the victims. These were zero-interest loans to the perpetrators. Bank of America got $1 trillion. Citigroup got $2.5 trillion. Morgan Stanley got $2 trillion. And Goldman Sachs, the firm that had bet against its own clients, received nearly $1 trillion in various support programs. Meanwhile, regular Americans got almost nothing. The Home Affordable Modification Program allocated $75 billion to help homeowners. Sounds generous until you realize only about 3% of eligible families received meaningful help. Foreclosures continued at 10,000 per day for years. Here's the system in action. Privatized profits, socialized losses. When the bets pay off, the winnings go to executives and shareholders. When the bets fail catastrophically, taxpayers absorb the damage while the same executives keep their jobs and their bonuses. Stage 5, the pattern repeats. Fast forward to March 2020. COVID hits. The economy freezes. Within 2 weeks, the Federal Reserve announces unlimited quantitative easing. They injected $9 trillion into the financial system over the next 2 years. $9 trillion. Where did it go? Straight into asset prices. Stocks hit record highs while unemployment hit 14%. Corporate bonds, including junk-rated debt from bankrupt companies, were purchased by the Fed at face value. Billionaire wealth increased by $1.9 trillion during the pandemic. Working class wealth barely moved. But the real move was in housing. With interest rates at zero and money flooding the system, private equity firms and institutional investors went on a buying spree. In 2021, Wall Street purchased over 300,000 single-family homes. They were outbidding regular families by paying cash above asking price with no inspection contingencies. BlackRock, the world's largest asset manager with $10 trillion in assets, became America's landlord. They're converting owner-occupied neighborhoods into rental markets. Why? Because the next crisis is already being positioned. When housing crashes again, and it will, these firms will own the assets at depressed prices, while regular families are underwater on mortgages or priced out entirely. Stage 6, the end game. This brings us to the present moment. Right now, the derivative market is back over $600 trillion. Corporate debt is at record highs. Consumer debt exceeds household income for the first time since 2008. The yield curve has inverted, which has predicted every recession for the past 60 years. All the warning signs are flashing. And the people who profited last time are ready to profit again. They're holding cash. They're shorting markets. They're structuring complex financial instruments that will pay out when the system collapses. Because that's what the system does. It inflates asset bubbles through cheap money, it pops those bubbles through manufactured crises, and it consolidates wealth as regular people sell at the bottom out of desperation. This isn't capitalism. Real capitalism involves risk. If you make bad bets, you lose. But when you're too big to fail, when the government guarantees your survival, when losses get absorbed by taxpayers while gains stay private, that's not a market. That's a wealth extraction mechanism masquerading as an economy. The truth. You need to accept. Here's the final truth. Every major crisis of the last 50 years follows this exact pattern. The 1987 crash, the savings and loan crisis, the dot-com bubble, the 2008 financial crisis, the COVID crash. Every single time, the same thing happens. Asset prices collapse, regular people panic and sell, connected insiders buy at the bottom with freshly printed money from the Fed, and wealth concentrates upward. It's not a conspiracy. It's documented policy. It's in the Federal Reserve minutes. It's in congressional testimony. It's in the emails released during trials. The system is working exactly as designed by the people who benefit from it. So what do you do with this information? First, understand that financial literacy isn't optional anymore. It's self-defense. Learn how money actually works. Understand what inflation really is, a transfer of wealth from savers to debtors, from workers to asset holders. Second, position yourself accordingly. Own assets that maintain value during currency debasement, real estate, commodities, businesses, skills that remain valuable regardless of economic conditions. But most importantly, stop believing the narrative that these crises are natural disasters. They're not hurricanes. They're engineered. And the engineers are getting wealthier every single cycle, while everyone else falls further behind. The next crisis isn't a question of if, it's when. And when it comes, you'll know exactly what's happening and who's profiting. The only question is, will you be ready?